Hello, everybody. Apologies that Claude is not with us yet. He will be with us momentarily, but I thought I'd just get things kicked off in the meantime. Hope everybody's had a good day. I know reporting season has been an exciting one so far. Just before we get into it, I hope you don't mind. I'm just going to go over the usual legal stuff. So we may have positions in some of the companies that we discussed today. That doesn't mean that we're recommending them. If anything that we do say, anything that we say is not intended to be financial advice, it's definitely, I wouldn't recommend taking advice from a podcast or a live stream, but we don't intend it as financial advice. And it's not a recommendation to buy or sell any products. Some of the information may not be accurate, or it might not be complete or current. And of course, past performance is not an indication of future performance. I'm sure we've heard it all before, but it is very true. We shouldn't be too far off Claude joining us now. Any interesting questions in the chat yet? No? Please ask questions in the chat. We would love to hear from you all. And I have good news. Claude is just joining the stream now. So I'm just going to add him if you just give me a second. Won't take a moment here. Sorry, this is new to all of us, so you'll have to excuse us. All right, hopefully that works if you just give us a moment. There we go. Claude,
live?
You are live.
We're doing
all
it now.
Appears to be working.
Cool. Let's see if I can share my screen. Here we
go. 1 second. I'll just need to set that up for you. Won't take a moment. All right.
Yeah, cool. There we go. Nice one. All right. Well, thanks for joining us, anyone who is tuning in on this one. I just wanted to quickly, I've just published my write-up for the Pro Medicus FY2025 results. So I thought I'd just go through it, give anybody a chance to ask questions just while it's fresh in my mind. Patrick, are you monitoring the YouTube? Will you see if people ask questions in the comments?
I most certainly will. I'll keep an eye on them and I'll let you know.
I won't notice that. And so essentially, I also wanted to check, have you read out the disclosure and disclaimer and that stuff yet?
I have. I haven't flashed them up on screen, but we'll put them up at the end, but I have read them out.
Yeah, okay, cool. Great. Well, we'll put them at the end, but as you know, I do hold shares in Pro Medicus, have owned shares in Pro Medicus since 2014. I bought it when it was under $1. I wasn't yet at that time an advisor at Motley Fool Hidden Gems. I subsequently joined Motley Fool, recommended it to Motley Fool Hidden Gems members, and have covered it ever since. And in recent years, obviously the thesis has changed a lot in that time when it was at $1.50. You know, I felt, first of all, you should have seen the sandbagging I did in that recommendation, saying how, risky I thought it was on 40 times earnings or whatever it was, 40 times forecast earnings, and how it needed to grow a lot to justify it, etc. Really the story here, if you take it the long term, is best encapsulated by this profit before tax margin, or probably a better, though similar, measure is the underlying EBIT margin. Now, which you can see on my screen there, which is from the screenshot from the article. Now, this is the bit that really sort of surprised me, because I remember back in those days when I first started following this stock, I used to model an underlying EBIT margin of 50%. Oh, Patrick, I think this might be, this is Clayton Hatch now, so I'm just going to have to duck out.
All right, that's convenient. So, as luck would have it, the CFO of Pro Medicus has just decided to give Claude a call. That's what we've been waiting on all afternoon. And of course, what caused the delays? In the end, we decided not to wait, and he called right as we were kicking off. If you guys just give me a couple of seconds, I've prepared a few things to go over. Here we go. In the event that this happened.
All right, I'm back.
to him again. Claude, you are on again.
Yeah, sorry about that. So I'll just relate that just because it's straight fresh in my mind. The thing that tripped me up this morning and like made me ask, it wasn't like that big of a red flag, or it wasn't like really a red flag or anything. It was more just a confusing point. Is that when I was going through the report, I noticed that for the purposes of their remuneration report, they had this sort of alternative underlying EBITDA figure, which was 152 million, which compared to the actual underlying EBITDA figure, underlying EBIT figure of 157.7 million. So I just spent way too long trying to like figure out how they actually got to that other number that you can see in my article. I've called it out. I'll just go to the relevant section, which I've now got to update now that Clayton just called me and explained it to me. But you can see there on the far left of that screen there, it's the underlying EBIT for remuneration in terms of whether people get the short-term incentive metrics was a different number. So I just wanted to know what that's about. And essentially, even though, so the 157.7 million, which is the true underlying EBIT, that's adjusted for currency and hedging impacts. However, this 152 number, that's also adjusted for what would the revenue be if the revenue had not benefited from currency changes. So in the profit and loss, which that 157.7 million adjusts for, the change in the value and the cash holdings and that kind of thing. Whereas that 152 number is like a kind of purely hypothetical number that they use for measuring performance, which presumes that the currency has stayed steady the whole time. So yeah, that makes perfect sense, and that's completely legitimate, and I'll update the article accordingly. But yeah, that's just the kind of little curious rabbit hole that I get into with Pro Medicus. So yeah, that's that. So that little nuance aside, at a high level, the big takeaways here you had extremely good revenue growth and profit growth. The growth engine remains the US. You can see there it's kind of just extremely good is also steady as she goes. So you can see the actual half-on-half growth rate in US sales that is pretty much within the normal range that we've had for the last 5 years now. So that's impressive, but also just continuing on the current trajectory. We saw this half-on-half profit growth rate actually come down ever so slightly, which is just because the revenue growth rate wasn't as impressive as previously. And the profit was assisted by record margins as well. So that's good to see the record margins. The comment there from the CEO was that we don't expect that margins will deviate materially from where they are now. However, with incremental revenue from recently won contracts, such as Trinity and UC Health, it is not inconceivable that margins could grow further. So back to the story I was telling at the beginning, the big reason that Pro Medicus has done way better than I could have ever possibly imagined was that margins just kept on improving way past where I ever thought they would. And I think that that's just a combination of them having genuinely little comparable competition and thus being able to price very keenly and get even more of the value that they create than most software companies do. And so, as a result, the margins have been really phenomenal, even by software company standards. And on top of that, it's a founder-led company with the two founders still on the board, long-serving CFO. They run basically a tight ship with an owner mindset. So that means, again, another reason margins can go very high. So we can at least say, they're probably not going to suffer heaps of margins falling, at least not anytime soon. Which leads me to the other point that I really wanted to make, which is basically that there was, I guess, it's a slight negative, is that when I've asked the CEO the same question on every conference call for like 10 years now, and that is essentially some version of have you lost any contracts to competitors out of your pipeline? And sometimes in the past, but I'll say in the last year or something like that. And sometimes in the past, the answer's been no, nothing. But then this time he said, look, we'll never have a 100% hit rate. I wish we did. That would be unbelievable, bearing in mind they simply outsell most of our competitors put together. The ones that sometimes we lose them early on, they just look at the price and say, you've got to be kidding. Having said that, it's not unheard of for those people to come back a few years later. And sometimes people are just looking at something and they feel their budget is X. So there will always be some that were excluded from fairly early on based on price. Sometimes there's also the concept of maybe the opposition have a broad range of products, which I hope nobody believes is the case. So we're not going to have 100%, but clearly our recent hit rate has been the highest we've ever had. So I think that the hit rate comment probably refers to them winning their two massivest contracts that they ever have had, and they've announced both of them in September and July respectively in the last year. And on top of that, there's hold on, I'm going to stop sharing that for a sec. On top of that, there's the potential. I've lost my train of thought there. Anyway, do we have any questions, Patrick?
We do indeed. I was just in the process of asking for a couple more. So I think one of the interesting ones that I've seen so far, where are we? Will there be any impact from the tariffs on PME, assuming, of course, Australia does get hit with some of those tariffs, which Trump
obviously
keeps changing his
we don't
mind
know
on?
What they'll announce in the future, but as of right now, no, because they're not tariffing software stuff.
Fair enough. And we also have another question here. So as somebody who has no position in Pro Medicus, how can we make a position or start adding to this company or to this gem as it was actually written?
Yeah, I think that the thing to do is to put it on a list of high quality stocks that you'd like to buy in a sell-off, and just have in mind through your own mechanism or whatever, have in mind a price that you'd be happy to buy shares for this company. Maybe set an alert in your broker so that if it trades below those levels, you'll automatically get an alert. And so I personally wouldn't I don't recommend Pro Medicus as a buy right now. Like, I continue to hold shares, and I definitely wouldn't be selling all my shares. I have sold some shares just in July around current levels, and I would potentially consider slightly trimming my position, which is my second largest position. I'd consider slightly trimming it further around current prices, but no current plans to do anything, but I may well do so. However, I think that the process for trying to buy it is first figure out what price you think you would like to buy shares at if it traded there, and then set your alerts and then actually do it. Because then the time that you ever actually get that price, the perfect setup is if there is just some overall market sell-off. And so I think if we look at the long-term history of even a high-quality stock like Pro Medicus, like the biggest impact on Pro Medicus share price are actually, now, because it's like one of Australia's biggest software and also health companies, the global liquidity conditions impact the share price a lot. So I'll just share my screen again to show you what I'm talking about. If you can sort that out for me, Patrick, to get it to come up. But there, like you see in the long term, I bought it in like 2014. It had several times where it came down like quite a few percent. Like, 2019, it got to something around 36, and then it went down to like 15. So it halved in that time. Then it got to 65 in 2021, and then went down to 37. So not quite halved, but like a similar amount down. You see, even in 2024, it had some disappointing results, and it dropped from 111 to 80 or something like that. And then in this most recent, Trump freak out, it went all the way from 300 virtually all the way down to under 200 for a couple of days there. So many times you see this stock will actually drop 30% for various reasons, whether it's overall market conditions or just even some disappointing results that came in below analyst expectations or whatever it is. So I would figure out your share price where you would like to add a little bit of stock. Obviously start small, don't go all in on some stock, figure out the price, in conjunction with your financial advisor or wherever you make those, however you make those decisions, and then just set the alert and buy the trigger when it happens, and do it. That's how I, sometimes you'll have to continue updating that price, because if you come up with a price and then you never gets hit, and then 5 years later the company's like gotten better and better, if you don't update that price, it'll never get hit. So it has to be sort of a reasonable thing that where the market might trade, and you're never going to get it super cheap anymore, but you could definitely think of it as, exposure to a high quality growth business. And in hindsight, in the past, most of the time it's been a mistake to sell and a good idea to buy, and someday that'll end. But right now, at least in the foreseeable future, it does still seem to have a lot of opportunity ahead of it. It has around, they reckon, about 10% market share in the US, and like we're saying, margins steady, revenues growing at it can vary in rates, but pretty high rates. And so you could just imagine that has very large, it could still have large upside if they succeed in making Visage a platform on which other people build their sort of algorithmic AI products that are used to diagnose or to assist diagnosis on radiology and stuff. So in that regard, they have a little bit of a strategy now. They've invested in two sort of startup companies. One's listed actually, 4DX, and the other, I've forgotten the name of it, maybe Elucid or something like that. It was in my half-year write-up, I think. But basically the idea here is that they're willing to use their capital to support the development of other companies that then one day may have a product that they would sort of host on the Visage platform. So they're really willing to use their capital, and they have over $200 million of cash and investments. I think it's smart, actually. They're using that to try and get this ecosystem for their platform, this AI algorithm ecosystem for their platform. It's very good idea, because when they put in $10 million to a company, that company is still going and raising capital from other people. And so in a way, they're kind of leveraging other people's capital to try and help build out essentially their ecosystem or their product. So it's definitely, and they didn't get much mention about it today, but they've developed like one product, which is like the breast density algorithm. We didn't hear much about that or anything about that. I'll see if I can even find, I couldn't find anything. Oh no, that's not true. In the announcement, it said, can you comment on progress on AI? What progress did you make with Elucid during the year? And are you looking at other such opportunities? And the CEO said, we signed a research collaboration agreement with University of California, San Francisco during the period, which we think will increase our AI capabilities. And we have signed a licensing agreement with NYU Langone to commercialize a breast cancer detection algorithm, which we co-developed and are submitting for FDA clearance. So there you go. This breast cancer detection algorithm, which they have developed or co-developed themselves for availability on their platform, that is taking the longest time to actually get any money. And that's okay, because you would expect it to. And they are still submitting it for FDA clearance, but they've signed a licensing agreement to actually start using that once it gets clearance. So that's exciting, and that's good news. And, the other thing I wanted to call out was that they've also signed their first sort of like proper commercial contract, which was the UC Health one, for use of their cardiology product, which is like part of the same platform essentially. So that was part of their product expansion as well. So that's, there's still evidence that the product expansion that they're doing, it's actually is working. Like when I first started covering Pro Medicus, it just had two products, the RIS product, which was kind of legacy and that they were redeveloping, but that was like, they didn't really get any sales of that until they'd finished that redevelopment or that rebuilding, and the Visage product, which is, the viewer. And now they have the viewer, they have the archive, they have the work list. And I guess like the fourth prong is like the cardiology aspect of it. So that was, I think, a positive sign. Like basically their team seems incredibly productive, like $7 million a year in capitalized software spend. The products they're coming out with, the revenue potential of these products, the fact that they seem to be top notch in the world. Like the real gem here is this amazing team of software developers that just keep on organically developing like incredible products for $7 million a year or thereabouts. So yeah, like that's kind of why to buy it. That's why the story is good. And that's why, you know, of course there would be a price where I would buy it. It's just like, I want to buy it when it's not so positive sentiment. You know, speaking of sentiment, that's probably another point that I wanted to cover off on before we go. Which is, look, I'll just share my screen again because this is a good graphic. But you see the short interest. You see the short interest over the last 3 years there. So it was a time when there was 5% of the stock was short sold, right? And now it's down to 1%. Now, when it's 5% short sold, well, half the company's owned by the founders. So that's like 10% of the free float. And that sort of serious amount of people that can be forced to buy shares later if they want to cover their position, which they may do if there's some sort of good results. And so that's the kind of thing that kind of can end up happening when it's high short interest. That can be a good time. Like that, if you're asking about when does this become a buy, well, I don't know the exact answers, but definitely one thing that I would look for when I'm thinking about when I want to buy is high short interest is like a positive thing in a perverse way there. So yeah, like at the moment, that's a sign that it's pretty optimistically priced. So we're talking about a PE ratio of 285 right now. So yeah, like it's pretty expensive stock, but it's a good stock. And you know, it's part of the index. So like if you're comparing yourself against the index and you don't own any of it, then you know, in effect, you're like that sort of underweight versus the index. So that's why a lot of fund managers, index hugging people would like kind of want to buy the stock. So yeah, it doesn't make heaps of sense why it's got a high PE ratio. It's basically just, I believe, comes down to the fact that there's very few high quality growth stocks that are going to grow for many years and get bid up to like quite high prices. If that equilibrium ever changes, then you could see a multiple D rate for Pro Medicus. But in the main, I see it as being like its share price is responding mostly to the fact that it's one of the best like companies on the ASX there, and therefore, you know, anyone who's invested in quality growth stocks ends up looking at Pro Medicus. And there's just like not a lot of them. It's tightly held by retail shareholders like myself that have been in there for years. And the founders have been very gradually selling, but they've been modest with their sales. So it's not like they're dumping heaps of stock or ever have. And so ultimately, it's still caught in this thing where it's like such a high quality business that it just fetches like such a high multiple. And what you got to watch out for is when do those profit growth rates slow down? And it could be any time. Like I said, the half on half profit growth rate wasn't as impressive. Having said that, they just signed their biggest contract ever in September, which would have hardly made, like it's definitely not fully rolled out yet, the Trinity one. That's going to take a while to fully roll out just because it's such a big organization. And even if it was, it wouldn't have contributed fully to this year. And on top of that, even in July, it signed its second biggest contract. So that's all to come in FY 2026 and into FY 2027. So there still should be some good growth in the next, like similar levels of growth in the next couple of years, and 10% market share. So look, it could easily become 5 times as big as it is now, which if it grew its profits by, that's the crazy thing is, you know, if it grew its profits by 5 times, it'd still be quite expensively priced for growth, but it at least could make sense then, you know, you could imagine it growing for a lot more than even like that would take it to 50% market share. Well, what if it gets 70%, you know, and what if it keeps growing its market because it has the AI algorithm platform and all that sort of stuff. So yeah, you can definitely get to the point where it actually does make sense now at the current price, which is why I continue to hold, because if you always just sold whenever it looked expensive on a PE ratio, I could never have, got this far. It's many, many times. I remember people telling me at $3, that it was ridiculously priced, that it was too expensive. It's just been the same thing I've heard for the entire holding period, basically, is that the bears say it's too expensive. And look, at some point they'll be right. But what I'll be responding to in terms of my view on the stock is what's happening in terms of the quality of the business itself and, its future growth rate and growth runway. I guess we do need to see it continuing to introduce new products over time to continue to grow that addressable market. And we also need to see it continue to get market share whilst it maintains such high pricing power. Where does this great run end? I think probably the thing that I worry about most is the potential for future competitive product to impact on Pro Medicus' ability to price in such a premium way. So that's a hard one to find out, to monitor what's happening, which is why I ask about if they've lost contracts to competitors and why, I guess. But I guess the red flag would be someone else at a similar price point managed to sell their software. That would be really concerning because it would imply there's a competitive product out there. And so, of course, any radiologists listening to this, please let me know about if you actually use the Pro Medicus products. That'd be really interesting. But I think, what it comes down to is whilst it still has the best product that is way better for radiologists and makes them way more efficient, then the value of the Pro Medicus software is related to how expensive the hourly rate of those radiologists are. And in America, they're extraordinarily expensive. There's a massive shortage of radiologists, ironically, because for the last 20 years, people have been telling medical students not to do radiology because it's going to get taken over by AI. End result, radiologists are really rare, really expensive. And thus, the profits on offer by making them more efficient are considerable. And that's ultimately, that's how Pro Medicus makes its money. So
nice one.
That. What other questions have we got?
We actually had a few come in throughout that. So I think one that's kind of relevant to what you were discussing just there is, are there any new players in the market that might be real competitors to Pro Medicus?
Sorry, Patrick, I lost you for a minute there.
Oh, sorry about that. Are there any new players in the market that are genuine competitors to Pro Medicus?
There are definitely genuine competitors to Pro Medicus. However, the best info I know on their various competitors is probably from the Baby Giants podcast that I did with the CEO a couple of years ago. That's probably the best information I have about the various kinds of competition they face. I can't remember all of them off my head. He mentioned on the call today Siemens, and he also sort of said that the competitors range, from Siemens to what did he say? The actual thing, I'm trying to remember my notes, was something like, little clouds, like cloud-based startups or something like that. But I think probably the threat ultimately does come from some cloud-based startups kind of situation, because if someone else, sort of cracks this code of how to actually develop this kind of software, or finds a novel way of doing what the Visage software does, it seems like the key advantage is about just streaming these huge images and being able to, with relatively low bandwidth, make it so that potentially a doctor can be at the beach or a radiologist can be at the beach and they can be looking at the scans on the iPad. And just, the technology to be able to do that is apparently quite difficult. So if someone cracks that would probably be the first ingredient to then having a serious competitor. But there's still so much more they need to do. They need to get FDA clearance for that software as a diagnostic tool. They need to, win their first customer. They need to be able to prove to potential customers that their thing is as good as Pro Medicus's. And, that's going to take some time. So something to monitor. I don't know who that's going to be. And in terms of, there's constantly new kind of competitors offering in this space. Even on the ASX, we have something like Max 7 that has vaguely analogous competing software. You had Volpara, which is now being taken over, but that competed with the breast algorithm part of it, breast density algorithm part of it. So there's various companies that would be like competing with various parts of the functionality, but in terms of a primary radiology viewer, like there doesn't seem to be any sort of anyone competing on product quality that I know of at the moment.
I might answer a question that somebody's asked here myself, which is that they missed the start of the live stream and will it be available afterwards? And the answer is yes. With YouTube live streams, they always go up afterwards. I think we're getting a little bit short on time, but one more question for you, Claude, that I think should be a pretty straightforward one. Do you think that they should do a stock split to free up some liquidity and make it easier for people to get into it?
No, I don't think so. It's just like it's a distraction, really. I think it's not going to be a major driver of long-term value for shareholders to do that at all, basically. But I guess, they will at a certain point. I guess by the time the stock gets to about $1,000, if it gets there, then it starts to become like inconveniently expensive. But no, I don't. It wouldn't be something that I would like care about in either way, really. At the moment, in particular, it's like $315 a share or whatever. Overall, not too worried about that. I don't think that sort of stuff creates long-term value anyway.
Are you up for one more, or?
Yeah, give me as many questions as makes sense. Rapid fire.
Okay. Curious if companies like PME give any bonus shares if we hold them for long enough.
No. I guess also like some companies do dividend reinvestment plans. I don't think PME does that. And in any event, the dividend's tiny, so it's kind of irrelevant. You don't want a company that's issuing shares or easily anyway, because the more shares they are, it's like a pizza, and the number of shares is the number of slices. So what you want them to do is to grow the pizza. It doesn't really matter whether you like have more slices or less or fewer slices to the value of the shares. It makes a difference to the share price, but it doesn't make a difference to your holding. It doesn't. It does give shares to employees, one of the reasons that it's managed to like keep, I guess, the team together, that's doing all this software developing, the technical team, is that they were all given shares. Well, not all, but the majority of them were given, share awards when they were was $5 a share or something like that. So they all have a pretty significant amount of money in the company now.
So we've got another one here. So it says, sounds like product expansion may well be the real gem. Is moving into cardiology next neuroimaging? Is move into cardiology. Oh, sorry. I see what they're saying. They've moved into cardiology. Is neuroimaging next? Oh.
Actually, the next product. So the cardiology, they just started basically getting their first commercial thing. The next product after that is pathology. They said, we're working on solutions for the other ologies to further extend our reach within the healthcare enterprise. Next is pathology that we are planning to release in this calendar year. Like cardiology, this will be part of the same code base as our Visage 7 platform. So what the platform consists of at the moment is like work lists. It consists of the viewer that allows radiologists to see the scans, and now also to review any ultrasounds as part of cardiology, plus any like just actual photos or whatever it may be, can all be done on that platform. I guess tracking the patient through that. I guess the pathology thing that they're thinking of building will be like part of that. I guess like trying to become the entire like the diagnostic platform for hospitals, what they use. Like you can imagine the vision here is that they're a platform. They have like the work lists as somebody tracks through the system. There's like it's the software that a radiologist or any doctor potentially logs into to see like their workflow, their actual the workflow that they need to do for all their diagnostic work. ideally on this platform. Now, I don't really know what that pathology product's going to look like. In fact, even this cardiology product that they've like essentially just started making revenue from, or will do quite soon, that I also don't really have like a super clear view over like how's that different or whatever. But the point is, it increases the number of users of the platform. So rather than just radiologists, it's also catering to cardiology specialists, and it's just doing whatever their diagnostic workflow is. And then I imagine the pathology products is just the same thing, but now we're aimed at pathologists. So yeah, that's where it's to next. That makes sense to me, basically, because, they're probably talking to their radiologist, colleagues, and the radiologists have got this jazzy new, really fast system that makes them more efficient. And the pathologists are using some terrible old system that needs upgrading. And they'll be like, we'll have that one, thanks. I think it makes sense, but that's where they're going to next.
I've actually got a question for you that I prepared. Have you done any update on the stonk ratio for Pro Medicus since we spoke about it last?
Well, so the stonk ratio is specifically a joke about how much the Pro Medicus share price goes up when it announces a contract win. So you need to know what the share price move was on the day that a contract win was announced. So it's not like really something you can do on the earnings results.
No. I thought I saw a contract result come in, but I realised now from you talking that was actually the investment in 40X that I was looking at.
Yeah.
So
but I think that the broader point is I sometimes look at the stonk ratio to gauge sentiment, and when I think the share price moving strongly today on these results is a good example that there's still like buoyant sentiment out there in the market. Like, if you look at the results, the revenue result came in less than 1% above consensus estimates. The underlying profit before tax came in 2% below analyst consensus estimates per CapIQ, and profit came in about 2% above. So it was essentially in line with, analyst expectations, this result, perhaps 2% higher if you want to be generous. And yet, we see the share price is up 6% today. So yeah, you can say there's like a buoyant response to like the results for sure. There's still a lot of positivity in the share price, which is a point that I guess is a key takeaway. Like, that's where we're at.
Look, I'll give people one last chance to ask any fresh questions if they'd like to. Just while we're waiting to see if any further of those come through, it's not really a question, but I just thought it was an interesting comment that I might read out, which is that Barrenjoey analyst Josh Kanarakis, sorry to Josh if you ever listen to this, said that the result was in line with expectations, and the most important news was that the company planned to release a new digital pathology platform this year. Was that something that really stuck out for you, Claude?
I wouldn't say that that's the biggest news. That's just that's a bit of new information. I think probably, the key takeaways from this actual set of results is that margins continue to go up. That is a positive thing, and I guess it's not surprising. I guess maybe it's like he's saying that's the biggest thing because it's like a surprising thing because it's like a new thing, and that is good. It is like a new development, and it makes sense for them to do that. But ultimately, I think these results were very strong, but also, largely as expected. No humongous surprises there. Like I said, if anything, like I came away a little more, impressed by how much they've pushed pricing. Like clearly they price very high, that there's a bit of sticker shock there for the customers, but they're getting 100% renewal rate. That would be like one of the biggest things I'd take away from it. Another big thing I'd take away from it was that despite the massive wins they've recorded, they've said they replenished their pipeline with other big opportunities, which is fantastic news. And on top of that, yeah, like I think it's just that. It's just like the strategy makes sense. They're on track. Yes, roughly as expected though. So hence why I'm not like, oh wow, this is so much better than I thought it was. It's just in line with it. It's in keeping with being steady as she goes, the best quality business on the ASX, and potential, could be another good 10 years ahead of it. But certainly, I wouldn't expect it to be anywhere near as good as the 10 years it's previously just had.
It'd be amazing if it was. It would be truly unprecedented, I think.
Yeah. I don't think that it's just, it has 10% of the market now already. I guess that's what in a sense, you got to monitor that. And yeah, other than that, it needs to remain strong on all metrics, like margins, profits going up, revenues growing well. The half-on-half revenue growth was, I guess, a little bit lower than it had been previous, like in the last couple of halves, but also it's got some big wins, so we might see that pick up in the next half. That'd be something I'm looking for. And the final thing I'd add, which I thought was a big win out of this result, is like they had just there's timings with cash flow that influences the cash flow result in any given year, but they just happen to have a good cash flow result this year, like where free cash flow was like over 100 million compared to profit of 115 million. So that's like really high cash conversion of profit to free cash flow. So yeah, just I think that they're key metrics that show the quality of the business. As long as everyone continues to perceive it as a really high quality business, the share price should remain optimistic, and then that's sort of why you're holding, because it'll remain a super popular stock while it keeps doing that, I think.
Awesome. Well, we've run out of questions, so we might wrap it up there. Claude, cheers for going through all that and answering the questions. Just before we wrap it up, everybody, I'm just going to play a disclaimer for you, and then I will end the stream. So please hang around. And
just before you do that, Patrick, thank you for the people that came and asked a couple of questions at short notice. I really appreciate that. Sorry for the bit where I was muted. I'm looking at the chat now. I'm sorry. I don't know. I didn't realize.
No, that was me, actually. Sorry.
You turned me off. Yeah, Patrick turned me off.
No. I muted myself when you went off screen.
Yeah, right. Okay, cool. Yeah, sorry. I mean, the irony was I was waiting for that call like all afternoon and just trying to delay the stream until after, and delay publishing the article until I got that call. I finally was like, just fine, publish the article, do the stream, and then I get the call. But that's Murphy's Law anyway. Lucky to be in a position where I can get my obscure questions about page 36 of the annual report. I'll tell a funny story, actually. So one of the reasons, the way that I ended up in Pro Medicus, as with my largest shareholding today, because Pro Medicus is only my second largest, is because I have a strategy as an investor to overweight my assessment of the integrity and quality and decency of management in my analysis and decisions. And as part of that, you kind of got to test people, right? And so in the early days of Pro Medicus, it was probably $3 share price. I remember going to an AGM, and me and another investor, Stella Wang, who actually asked a question on the call today as well. We're still asking questions. We just tag teamed the CEO and CFO and asked them probably 20 difficult questions, the hardest questions we could come up with, explain this, explain that, really digging into it as much as possible. And it was it wasn't in a bad spirit, because we were shareholders and we were there and we were all happy with the result, but we were really getting into a bit of almost an interrogation. And then just the good spirit with which they took so many questions, not just from us two, but also from other people being increase the dividend or this, that, and the other. The good spirit with which they engaged was probably one of the things that helped form my opinion that I thought they were really high integrity board and management, because they just really were committed to helping us understand the company as well as possible. And, Clayton getting back to me and pointing out the thing that I was missing when I was failing to understand that page 36 today, that still confirms my view that the management's high quality, high integrity, that I trustworthy. On top of that, his explanation made sense. And on top of that, he was like, oh yeah, we could have, I'll take it on board that we could explain that better in the notes or whatever. So just that, those kind of positive qualitative interactions, they do weigh into my investing, because ultimately you've got to trust management. That's a good thing to be biased towards. You take into account other considerations, of course, like valuation, growth rates, quality of the business, is it capital intensive? On all of those things, Pro Medicus scores well, it also scores well on integrity of like leadership and management. So that's like another reason why I continue to hold it despite its really high PE ratio. Anyway, end rant. Thank you for listening, everyone. Yep, of course, let me know any questions in future live streams. Let us know what you think in the comments. If you have comments about Pro Medicus, feel free to put them in the comments of the YouTube video, which we'll post up for people after the fact. So yeah, thanks a lot and have a good afternoon.
Thanks everyone. Thanks Claude, and roll the disclaimer. Guests or podcast hosts may have positions in the companies mentioned in this recording. The information contained in this episode is not intended as financial advice and is not a recommendation to buy or sell any financial products. We do not warrant or represent that the information, opinions, or conclusions contained in this episode are accurate, reliable, complete, or current. And you should be aware that any references to past performance are not an indication of future performance.